Okay, someone asked for a video on how the bond market impacts mortgage rates.
How the bond market
Impacts mortgage rates.
So traditionally, or like it's like customarily or normally, whatever the word is, it's 10-year treasuries, because you use the 10-year treasury as a gauge of where the mortgage market goes, or even longer term on like 30 years, but not so much. You use the 10-year treasury. Why? Our mortgages in this, the majority of mortgages are government backed. They go to Fannie, Freddie, they go to agency debt. They're government backed. So that market has to compete with the U.S. Treasuries. It competes, right? Your pricing competes, right? So that's why mortgage rates, which are derived from government-backed debt, Fannie, Freddie, that's sold in the secondary market, is highly correlated with the treasury rates, namely the 10-year treasury, because that's what it competes with in the secondary market. Does that make sense? In the capital markets, people are buying, people instead of buying mortgages, they're going to buy treasuries. So the mortgage-backed securities compete with the treasuries. Mm-hmm. So that's why the rates are very close. So when the 10-year treasury moves, technically the mortgage-backed security rates have to move along with it, because they're competing for bids. They're competing for buyers.
Right.
That's why. So that's how it's linked. That's I know it's convoluted, but that's just how it works.
That makes sense. So when someone's selling like a tranche of mortgages on the secondary market, a buyer might be looking at those mortgages, or they might be looking at treasuries.
That's right. So when your treasury moves a certain way, technically the price of your mortgage-backed securities have to move a certain way too, to compete with that treasury.
Right.
Make sense?
Makes sense to me.
Yeah. There's a little bit more of a spread on mortgage-backed, because treasuries are direct government-issued debt. MBS, mortgage-backed securities, are government-backed securities. There's a difference. So there's a little bit more risk premium there, but they still track the same way.
Got it.